I have a couple thoughts on this.
Yeah, dive
You know,
right
generally, I feel that people get so connected to searching online, right? Their phone, their computer, they're looking at property, and then they find the one that they love, and they call that agent who's listing it, and they're not qualified, and they lose out on the property, right? So for us, I try to advise people, listen, we're not going to force you into anything. We're going to coach you. We're going to give you good advice. There's no pressure here, right? We want to educate and make sure you feel comfortable with the process. So start it early. Start it a year earlier. Start it 6 months earlier, right? Let's not rush the process. Let's make sure we have time to pull your credit, take a look at it, see if we need to improve some things. Make sure your income is in the right place. Maybe you're thinking about a job change in the next 6 months. Let's lay all these things out. I think people are fearful that if they talk to us and we don't like their credit or something about their scenario, that we're not going to talk to them anymore, right? And that's just not the case. We want to help. We want to coach and guide. So get ahead of it, be prepared so that you can jump on that property. And by the way, build then a really good team around you, a good real estate agent that you got a referral to, not necessarily just someone you're calling on a whim, right? Build that team, get prepared, feel confident, and then you can really jump on that opportunity.
Start
when it
early.
comes up.
Yeah, right. I mean, I think that's the biggest mistake that people make is starting too late. If you start early, it's like anything else. You can get your ducks in a row and makes a good decision. Loan types for first-time home buyers. First one that people typically ask about is FHA, Federal Housing Administration loan program, government loan, 3.5% minimum down payment.
Yeah.
More forgiving debt to income ratio than conventional. More forgiving credit-wise as well.
Yeah, credit profile, yeah.
Little higher PMI, upfront mortgage insurance as related to conventional. Conventional is going to be better. If someone has a really high credit score, 5% or more to put down, absolutely FHA really doesn't even come into the conversation. I find that that's like usually surprising to people. They always think, well, I'm a first-time buyer. FHA kind of sounds like first-time buyer the way it is in the name of it. But it's not something that I think we're always going to look at what's the best program for the client. FHA has its use. Conventional has its use. USDA, if they're in an eligible area and their income is within the limit.
Even VA.
Yeah, VA is a great program. If someone's a veteran, we're going to look at what's their a nice thing to know about the VA program is going to be whether they're exempt from the funding fee or not.
Sure.
Right. That's a huge, when someone's exempt from the funding fee based on having been discharged with a disability, part of the benefit of the VA program is that it makes them exempt from the upfront funding fee, which is a really nice benefit to have because then there's no PMI in the VA program and very forgiving on debt to income ratio. Rates are really good. So if someone is a veteran, we're always going to look to that program first. Even if they have a good amount of money to put down, sometimes it's just going to be better for rate. And if they're exempt from the funding fee, it's going to be really terrific for them.
Can I comment on one thing, Roger? I think that you started to go down this path. When we talk to first-time home buyers, they tend to get really hung up on, oh, I don't have 20% down. Well, you don't actually need 20% down, right? There's plenty of programs that allow a lot less than that. So, and it's not just down payment. I tell people there's 3 factors that go into it. It's how much money do you have down? What does your credit profile, credit score look like? And your debt to income ratio. So these are a few things we look at, and every program has pros and cons to it. And so, yeah, like you were mentioning earlier, there are cases where if someone can get 5%, even conventional, you can do 3% down, right? So there are cases when if you've got a decent enough credit profile, you can go with conventional financing and bypass FHA out of the gates, or avoid another type of government-insured program. So I think Fannie Mae and Freddie Mac are trying to do a better job of creating some lower down payment programs because generally a first-time home buyer doesn't have the 20%, right? They're not selling a home that they're going to net a bunch of money to transfer over as down payment to the next house. So Fannie Mae and Freddie Mac have done a good job creating some new programs to help folks with lesser down payment if we can work that credit profile and make sure that they're eligible, then there's, they're gonna have some more options. And like you said, they're surprised by that fact.
All right, so let's do loan types first-time buyers would consider based on down payment, rapid fire round, right? So, so if we start from lowest down payment available in any of the programs, what's your first one that comes to mind?
Well, the first is VA. It's no money down. It's the best loan going if you're eligible, right? If you're a veteran yourself and you're eligible, you're a surviving spouse, you're eligible, then best loan going, especially like you said, if you're exempt from that upfront funding fee. USDA, no money down beyond that, right?
Yep.
You were going to say something.
Well, I was going to say, so I think a big thing that clients we want to make sure is clear to them is 0% down. Does that mean no money to buy a home?
Oh, good point. Yeah. Right. So it's down. There's two factors here. It's down payment, and then it's your closing costs, your settlement costs, right? The costs that are associated with obtaining the mortgage, buying the property, setting up escrow, let's say. So it's not, when there's no money down, there's still some costs associated that you need to be prepared for.
Yep. And so then there's then that covers the 0% down. What's our next one?
Really, it's conventional because they have a 3% down program, which is a nice option.
Any restrictions on income eligibility or geographic with those programs that you're thinking about?
So whether you're looking at Home Ready or Home Possible or a couple different options, so then they do have income caps, which we can, we'll get into, but there are websites people can search as well for that information. So there are some income restrictions because Fannie Mae and Freddie Mac are trying to cater this product toward a lower or moderate income family, right? They don't want somebody who makes, $150,000 a year in some circumstances to be able to take advantage of that lower down payment. Now, beyond that, there are some additional conventional programs where you can put 3% down. There is not an income restriction, but you have to be a first-time home buyer. You can't have owned a home in the last 3 years. That's the definition. First-time home buyer. As long as you haven't been on the deed to a home, you haven't owned a home in the last 3 years, then you don't have the income restriction. You can put as little as 3% down.
All right, so we've covered 0% down. We covered that was VA and USDA.
Yeah.
We covered conventional 3% down. Then what's next?
FHA, 3.5%.
Mm-hmm.
Yeah, is the minimum there.
And then from there, we're going to go into conventional 5% down, which is pretty traditional, what most people think of when they're getting a loan.
Yeah, and we're talking basically single-family homes. There are some layers to this. Once you go multifamily with conventional, that changes a little. The benefit actually to FHA, the nice piece is you can actually buy up to a 4-unit, right? A single-family up to a 4-unit home with the same 3.5% down on an FHA loan. So there's nice benefit there. If you intend to truly live in that home, you can actually buy that property as a multifamily, collect rent from those other 3 units. As long as you're going to move into that home and live there, you can do that as an FHA loan as your primary residence. And that's a really nice first step for anybody that wants to build an investment portfolio. You're living in that home. It's a primary. FHA allows it. It's a great option.
Awesome. Do we have anything with grants?
Actually, yeah, great point. So there are some state agencies that'll offer some additional financing, whether, down payment assistance, right? So we're fortunate enough to be teamed up with New Hampshire Housing. And so they have some really nice cash assistance programs up to 4% down payment assistance. And it can be applied toward down payment. It can be applied toward even, closing costs. It acts as, with New Hampshire Housing, it acts as a second lien on the property that eventually is forgiven over so much time. If you were to sell or refinance, then you have to pay it back. So there are some terms and conditions you want to be aware of getting into that. And then other states we've seen where municipalities will have cash assistance or grant programs for generally first-time home buyers under a certain income limit. And generally, it's the same thing, right? It's usually a second lien on property. It might be what we call maybe a silent second, where you're not making a payment on that second mortgage. Same with New Hampshire Housing. There's no payment you make on that second lien for the cash assistance. It's really there for the purpose of helping you, obtain the down payment to purchase that home And after a certain period of time, generally those are forgiven as well. So look into, again, we're in New Hampshire, look into New Hampshire if you're there, but outside of that, the other states we're licensed in, talk to your loan officer, do some research online, and you might find the towns that you want to purchase a home in might also, or towns or cities, might also offer some down payment assistance.
Great. So now we're going to talk a little bit about pre-qualified versus approved, right? So it's really important that people understand before they have a property, really before they start looking, they should talk with their mortgage professional, run their credit, take a look at the debt to income ratio, have the mortgage professional review their documentation, income, W-2s, pay stubs, bank statements, things like that, and issue a pre-qualification, which is not going to be property specific, but it's going to be client specific, and it's going to give an amount that the client can finance based on the down payment and money they have saved and the income they have. Approved is going to be once someone goes under agreement for a property, applies for their mortgage, files their mortgage application, all the due diligence is done to update credit, verify income, confirm they're still at their jobs, review the bank statements for deposits and where their down payment money is coming from. That's going to lead to an approval. So really people want to differentiate the pre-qualification is before they find property. The approval comes after they're under agreement and apply for that loan for that specific property.
That's great. Kind of one thought there too. When someone is going through this pre-qualification process, pay attention to how detailed your mortgage professional is. If they're not asking you for pay stubs and other supporting documents to really look at your profile, to understand your profile, you might not be getting the benefit that you need there, right? Which is really making sure they're turning these rocks over to look for anything that might create a problem later. I tell folks, I've learned this from you, Roger, right? It's like we're going to do the work up front, and because we want to avoid the potential pitfalls later on. So let's invest the time now to make sure that we're in a good spot. So even though it's a pre-qualification, it's an in-depth process for us. If we're going to send someone a letter and tell them to go house hunt, especially a first-time home buyer who's beyond excited to get that letter, right, and start the house hunt, we want to make sure we're going to come through in the end for them.
Because there's a lot of nuance to the guidelines, how things work. Everybody's scenario is so different. So it's really important that the mortgage person dive in, really understand it. And it's really hard to do without that, with someone trying to just do it online or go through some widget on a website to figure out, how much can I actually do? You really want to talk to someone that understands it, because it's so hard to take all those guidelines and put them into a computer model that someone could do on their own without the help of like a human to figure it out. Let's talk a little bit about PMI, so private mortgage insurance, premiums, things that come up with that. So PMI is going to come in. So let's go by program, right? So let's start with our USDA. So let's go from minimum down payment to we'll start there and kind of work down the list, right? So USDA, do we have PMI there?
We do. You're talking about kind of a fork in the road, two different paths, right? These government loans, USDA, VA, FHA, which isn't actually considered private mortgage insurance. They'll refer to it as MI, mortgage insurance. USDA has a guarantee fee, which is an upfront fee they charge that they roll into the loan, and then they charge an annual or monthly mortgage insurance premium as well. That those are factors based on your loan amount, so those amounts will vary. Same thing with VA, charges an upfront fee, what they call their VA funding fee. And by the way, these fees go into a pool that allow these government agencies to operate this program, right, and allow funding for these programs. They insure and protect essentially the lender who's funding those loans, right, at these higher loan-to-value ratios. Up to 100% loan-to-value ratio is a higher risk loan, let's say. And so the VA comes in and gives our lenders the support and the insurance they need to fund those loans. FHA say, so back to VA real quick. So upfront funding fee, no monthly insurance, which is why it's a great product. And furthermore, with VA, if you are a disabled veteran and you are exempt from the funding fee same thing, their VA funding fee varies depending on type of loan, how much money you're putting down. But you could be exempt from that fee where the VA will actually waive it altogether. So if you're an exempt veteran, you won't have the upfront, nor will you pay a monthly. So that's why and the rates are really competitive. So that's why it's really one of the best loans going. FHA charges their upfront mortgage insurance premium as well as a monthly premium. You might see sometimes it's referred to as annual. It breaks down to a monthly amount. And so all of those programs are paid in for that government insurance. And then beyond that, you have your regular, once you get into the conventional realm, then you're talking about private mortgage insurance where that insurance policy is being provided by an actual business, a private entity, let's say, like MGIC or, some Radian, exactly, Essence, some of these larger mortgage insurance companies. Think of just like you'd insure your house, where they're insuring the mortgage.
And so, the way I always think about it with clients is sometimes they get frustrated at the PMI that it exists,
Yes.
right? And I always say, well, like years and years and years ago, before the PMI companies came to be, everybody just had to put 20% down.
Right.
So you had to wait. You had to rent longer. You had to lose money to renting and not be in space that you like and not have ownership and appreciation. I always look at PMI now, especially with how it has become so fine-tuned to the risk of that borrower,
Yes.
related to their credit score. If someone has a very high credit score, the PMI is, I look at it and I'm always like, it's just worth it to almost keep that money in the bank working for you, and get into that home sooner so you can get on the elevator of appreciation and the tax deduction of owning a home. So I think PMI is really a nice thing that it exists. Understand how it works. Understand that across the different programs, whether it be the government programs where it's called just mortgage insurance, and then the conventional programs where it's called private mortgage insurance or PMI, they all kind of have some variation of it. And it's important to understand that it exists there, and it does provide a benefit to the client to be able to get into home ownership sooner, which, again, home ownership is typically something that over time is really where you're going to find the benefit of it. So yeah. I think PMI really just is a great addition to the market to allow the market to work well.
Yeah, it's a tool. Real quick, I'll just mention, I try to explain to folks, it's different than when let's say our parents, or 30 years ago, 20 years ago, whatever it was, PMI was a lot more expensive then. The prices, as you said, I think there's been enough historical data to document that even if you're only putting 5% down, if you've got a good credit profile, generally those can be a lower risk loan. And so these mortgage insurance companies have dropped the rates on them. So it's a tool to allow you to get into that investment sooner. And it's not nearly as costly as people might think, or as it was in the past.
All right, tips on how to make an offer on a home for the first time. So goes back to get pre-qualified early, understand your credit, understand your budget, talk to someone who cares, talk to your financial planner, talk to your mentors in your life, your parents, your friends, your guardians, people that that have been through the process before you. And that's really important. So get pre-qualified, understand your budget, get a solid pre-qualification with numbers, stipulations, items needed to get approved, overview of the process. I think where people can have some trouble with first-time buying is that they just get a letter and they go out, they get under agreement. They have no idea what's coming, how it's going to work. I think one of the differences in working with us is that pre-qualifications is going to come with really some education to the client so that they can really dive in and transact in a market that moves super fast. Like, most people find the house that they're going to like at 7:30 p.m. on Friday afternoon, when if you're not working with someone like Blue Water Mortgage, you can't get your loan officer on the line, or you got to make a decision quick, and you need to know that what you're thinking is actually true and how it's going to work. And I think that's where partnering with someone like a Blue Water Mortgage that has, loan officers who care, understand your scenario, you've prepped for that, they've told you it's going to happen fast, and then when it does, you've got your plan so that that makes you a more viable buyer to beat all the competitors that are trying to get that same property. So pre-qualified early, someone who cares about you, someone who's available. That's number one. Number two, find a realtor that thinks the same way as that. Be prepared early, understand it's someone you can trust, get a referral, check their references. Hopefully it's someone that's worked with someone that you know and they've said great things about them. Referrals in the mortgage and real estate space are super important. In working with firms, mortgage people, companies, realtors that develop their business through referrals, I think is really important, especially in whatever local area it is throughout our country. There's going to be the top 2 or 3 or 4% of the professionals in that area that do most of the business, that when you ask around town, do you know this person? People say, yeah, I know them. I worked with them. They're great. Or my friend worked with them. They did a great job. Because so often people, you don't know what you're getting till you're 3 steps into your transaction with your realtor or with your mortgage professional. You don't really know how they're going to work, whether it be quickly or if an issue comes up. You're going to really want someone you're super comfortable with. And over the process of finding them, were they quick to get back to you? When they answered you, was it concise? Did they make you feel like you were their only client? Those are some of the things that I think are important when people are figuring out who they want to use for their team when they're getting ready to make their offer on their first home. Other things that matter are look around at the market, really make sure you understand it. That's where the realtor comes in. The numbers for the mortgage financing, that's going to come in from the mortgage professional. In certain markets, there are some things you can do to make your offer more competitive, like having a mortgage company that can close in a more marketable time frame. So when I'm talking to clients or agents, they'll say, if everyone else is offering with requiring 60 days to loan commitment and another 10 days after that to closing, versus a lender that can provide mortgage commitment within 24 days and close within 6 days of the mortgage commitment, that's going to make you a more competitive buyer to that seller as they're evaluating their offers. You can close quicker. Also, the brand name of who is on that pre-approval letter or the pre-qualification. The name that's on the pre-qualification letter is going to really matter to the seller in that area. The listing agents know who they can trust for lenders in any given area of our country, and they know who they can't. They know who the brand names where 30-40% of the transactions that come through their office with that lender close late. The clients are frustrated. Things fall off track, and there's a ton of heavy lifting to try to get it done. But then they also know who is like, oh gosh, those guys are great, or those guys, gals, those people do a great job closing their loans on time. We've worked with them repeatedly. So usually a company that has nice roots in any local area throughout our country is typically going to give you an advantage when you're putting that offer in. So summarizing, time frame to commitment and closing, local brand awareness and trust is going to be very important tip on getting your offer accepted. Understanding what you're going to need, whether you're going to need an appraisal or not. Some clients, we talked about appraisal waivers before. If we can look at the property early and figure out, does it get an appraisal waiver or not, that is a nice little nuance to understanding how the market works, to being able to figure out that it's not going to need an appraisal with that client, with that specific property, and to go into your offer with that built in, where someone else who's more professional either didn't understand that nuance, didn't take the time to run the property for that client prior to the offer. It takes, not very long, but it makes a huge difference in being able to put in an offer if you know you're going to get an appraisal waiver and you as the client are comfortable with the number that you're offering and feel like you don't want an appraisal. In a market where there's so many home buyers versus sellers, that's a little advantage. And that'll ebb and flow over time. There are times when it's a buyer's market and you can have longer time frames, more stipulations. And that's something that you'll work with your realtor and your mortgage professional to know how you feel transacting in the type of market that you have at the current time when you're trying to find your property. And that closes out the things you want to consider when you're a first-time home buyer: how to build your team, get pre-qualified early, and the things you want to know about mortgage insurance and calculating your debt-to-income ratio.